And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Tuesday edition of The Real Investment Show. Last half of the month. Getting ready to end the quarter already, which means that we've got earnings season coming up right around the corner. Also means that the buyback window is about to start closing here in the next few days. So again, that's been one of the, and really when you kind of look at the markets, you go, well, it really hasn't meant a whole lot this quarter, and that's been a true statement, but buybacks have been going on, and of course that window is going to close. So it is going to remove a buyer here, at least temporarily, until we get into earnings season in the next couple of weeks. So again, we've had, and we'll talk about this in a few minutes in the Before the Bell segment, but nice rally yesterday. 90% of stocks were higher yesterday. That's a good kind of bullish sign. Get a bit of a short squeeze here, but be careful with this rally. It's still tenuous at best. Again, doesn't mean we're going to have a bear market here, but we may not be done with this correction just yet. Well, again, we'll talk some more about that in a few minutes. Outside of that, economic data, got a good bit of that coming in this week, and so the retail sales report came out yesterday. A little bit weaker than expected, but still not bad, right? So, and the reason I say that is because, again, a lot of headlines here with this decline in the market was all about recession, right? Oh, the recession's right around the corner. That's why markets are selling off. Recession fears, blah, blah, blah. A lot of people running around out there kind of just spinning these lies about the market. They've got like stage 4 lyabetes talking about, recession right around the corner, and there's no evidence of that, right? Retail sales are doing okay. The consumer makes up 40% of PCE. PCE makes up 70% of GDP. There's not really any evidence at the moment that we're going into a recession. Now, can that change? Absolutely. And it will change at some point in the future, just later, right? But there's no evidence right now of a recession. So this has just been a decline as of late. I know it's been weighing on people, but again, just a decline in the markets. We had a lot of exuberance that's getting kind of backed up here a bit. So again, but take a look at retail sales. Again, core retail sales up about 1%. Retail sales on the headline still doing okay. Again, that consumer certainly showing some signs of weakness. And again, this is exactly what we've been talking about now for the last 6-8 months, is that all these expectations of exuberant economic growth rates, higher inflation, higher interest rates, that was never going to be the case because the consumer's slowing down, and they're going to continue to slow down as this money continues to get extracted out of the economy. Now, that is unless we get another big spending bill of some sort that injects capital into households, or if you send $5,000 doji checks to the households, certainly that's going to change the dynamic. But outside of that, the trend of economic growth is slower, and that's going to continue to be the case this year as we get further into the year. And again, economic growth should return to somewhere around 2% by year end, right? And so that's going to drag interest rates lower ultimately, because that'll pace down to GDP. Inflation will come down to track GDP as well, because inflation's driven by economic activity. So egg prices down over the last couple of weeks. Everybody's all excited now. You can go buy eggs cheaper. So just in time for Easter, right? Now we go waste a bunch of eggs for Easter. I remember growing up, right? You'd actually boil eggs, and then parents would hide the boiled eggs, and you go out and go, "Yay, it's Easter! Let's go get boiled eggs." And then nobody ever ate the eggs, right? Exactly. Been sitting out there for 4 days. Exactly. All right, so let's talk a little bit about the markets. A couple of things that are going on. Obviously, yesterday, again, had a bit of a follow-through rally. As I said, 90% up day yesterday. That's a good, healthy sign. A bit of a short squeeze here. Starting to turn the MACD buy signal up. Not there yet. So again, we're still in an oversold condition. Momentum is improving over the last couple of days, but it wasn't a really strong rally, right? We had a good, strong 2% rally on Friday. We were up about 69 basis points yesterday. Again, I would like to have seen a bit more follow through, and particularly in some of the bigger mega cap stocks. They were weak yesterday. This was more of a value rally yesterday versus Friday, where we saw a lot of the big mega caps. So again, this market's just rotating very quickly through sectors. But again, nonetheless, we're starting to approach that 200-day moving average. So this is going to be key first resistance here. Market needs to get above that if we're going to continue to make this advance. I would suspect that we're probably going to get stuck here for a little bit. Now, again, we probably may retest these lows, maybe even set a new low here before we kind of finalize the bottom here in this correction. So again, we could have a little bit more work ahead of us, so don't be surprised about that. If the market, if your portfolio has really been under a lot of pressure, use that rally yesterday. When the market opens up today, we're going to be down a little bit this morning, but likely I might see some buying come in. Use that to start kind of rebalancing some risk in your portfolio if you need to. Again, there's a real possibility we kind of get stuck here over the next few days. We'll have to wait and see how kind of markets respond. But again, we are oversold enough now. There's some fuel there. Negative sentiment is large enough as well that if we get a little bit more of a squeeze here higher, that's going to force a lot of these hedge funds and kind of computerized trading algorithms, et cetera, the CTAs, they're going to have to come in and start buying. And so if we get a little bit more of a rally, that's going to force them to start buying. And there's about $40 to $42 billion worth of buying that they'll have to do if this market gets up to the 200-day moving average, particularly if it breaks above that. That's going to bring a lot of buying into the markets just as those kind of algorithms reverse back onto a buy signal. One of the interesting things, obviously, that's kind of been going on is Bitcoin's been under a tremendous amount of pressure here as well. Again, not surprising if the market corrects, Bitcoin corrects, because of the correlation. Really, these are highly correlated assets. Bitcoin is simply just a levered proxy for stocks. So again, just all these other theses out the window. It's really just if you want to trade a levered play against stocks, you buy Bitcoin. That's been under a lot of pressure here, flirting with the 200-day moving average as well. We need to see a bit of a turn here. You're about to get a buy signal on Bitcoin. If we start to see Bitcoin get some flows come in here, that should also feed over into the NASDAQ. Again, very, very high correlation between the NASDAQ and Bitcoin as well. But again, that's been under big pressure, sitting around 82,000. So we'll have to see if that can get turned around here as of late. Lastly, as we've talked about before, gold's been doing very well here. It's been having a nice move on this kind of a risk-off trade as well. So we've seen money come out of stocks. Gold's been rallying nicely here on a buy signal, getting very, very overbought. Last time we were this overbought, had a decent correction, gave you a good buying opportunity to add it to the portfolio. But again, you're now back to very, very overbought levels. And on a weekly basis and on a monthly basis, you are in extreme overbought conditions on gold. So again, that's led to longer term consolidation periods. Doesn't mean right now, but just kind of as with any asset class, you're getting into a position where you're now more extended on the upside. So don't forget to take profits, rebalance risk. Same thing you do with anything else. Bonds are the same way. We've had a very nice rally in bonds over the last couple of days in particular. Bonds are sitting right on support right now, trying to turn up. So we previously tested that 200-day moving average for bonds on a bit of a sell signal right now, working off some of that previous overbought. So again, like we said with gold, when things get really overbought, you tend to get a little bit of a correction. That gives you a better buying opportunity. But again, we're still kind of working through that process right now on bonds. So quick run through the markets. That's what you need to know before the bell this morning. When we come back, we'll pick up with John Penn. Got some issues to get into this morning. Talk a little bit about retail. Retail buyers are very interesting right now. They don't want to sell. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP GP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I've determined I have the stupidest dog on the planet. So this morning my dog gets up, Sniper, one of the two, right? He gets up out of bed this morning about 3 o'clock, goes outside. He has a dog door, so he can go in and out of the house anytime he wants, right? So I hear him get up, and I hear him go outside because I hear the dog door flap, right? So I know he's outside doing his business. That's great. And I fall back asleep. I didn't sleep well last night, right? So I finally fell into this really, really good sleep about an hour before my alarm goes off to come down here. I told John this morning, he was really about this close to me going, I can't get in this day. John, you have to do the show. But anyway, I never heard him come back in. But so my wife gets up to go feed the dogs about 4 o'clock this morning, and she comes in, she goes, where's Sniper? I said, I don't know. I said, he went outside about an hour or so ago. And so she goes and looks outside. Now, we have this big sliding glass door on the back of our house that overlooks the backyard, and he's in the corner of our porch, right? Just like huddling in the corner of this porch because he can't figure out how to get back in the house. So he's completely terrified.
Poor Sniper.
So he's completely terrified outside. He's scared of everything, right? Anyway, it's like a leaf blows. He's scared of a leaf. I think he's part Chihuahua. I'm not sure. Anyway, so finally, he gets back in the house and everything's fine. But I'm just like, you went out the dog door. Why could you not figure out how to get back in the dog door? But he does it all the time. I mean, he uses this dog door every day because my wife and I both work. We're out of the house all the time. So they can both let themselves in and out. It's fine. And why he couldn't remember to use it this morning, I have no idea.
And the dog door is completely open. Like
it just
swings.
It's completely fine. He went out and he come back in. He uses it all the time.
You don't have to worry about other critters coming in, possums, squirrels, anything like that?
No, just 9-banded armadillos, which, Larry, I did know was the state animal from our chat. So
to watch out for those armadillos.
Blue bonnets, mockingbirds. Yes, got it. So orange construction tones. Correct.
Those do seem to multiply.
State warnings.
They never go away.
Official state warning sign.
Yeah.
I'm not sure if it's the official orange cone or if it's all of the Whataburger numbers that people steal from Whataburgers that are the official, maybe the official state warning sign. I'm not sure.
That is true.
All right, a couple of things getting through this morning. As I noted just before the break, retail investors right now are very interesting. They are very, very interesting what's going on. Brent, can you bring this chart up for me? So, despite the sell-off, despite all of the headline warnings and all of the people making comments and articles about, we're about to head into a recession and all this other stuff. Retail investors are buying the dip. They've been buying this whole decline. Now, normally the reason this is interesting is because normally they're selling the decline. They're panic selling, right? When markets are down 10%, you got all these negative headlines, they're out selling all their stocks, right? And they're not. They've been actually buying the market all the way down. This is kind of an interesting dichotomy of behavior, particularly. Now, Brent, I'm going to have to change charts on you here real quick. The reason this is particularly interesting is they're buying the decline. And you go, well, that makes complete sense, right? Because you want to buy stuff when it gets cheaper, right? But at the same time, they are when they're surveyed, they're going, oh, this is terrible, right? Markets are terrible. Go ahead and bring it up. I'm super bearish on the markets. In fact, bearish sentiment of both retail and professional investors is at levels that are normally seen at the 2022 lows, the financial crisis lows. I mean, you rarely get sentiment as negative as it is right now. But at the same time, they're saying that. Okay, I'm going to change charts. At the same time, quit taking notes and pay attention to the show. But at the same time that they are saying how scared they are, right? They're buying the market, and this is quite fascinating, And this even shows up in the allocation holdings. So if you take a look at this, so this is the American Association of Retail Investors, individual investors. This is their allocation to stocks versus cash. So during this decline, right? They've been buying stocks and saying how terrified they are. In fact, as I said, you rarely see periods where they are this fearful of the markets sentiment-wise, but yet they've made no change. And this is, like I said, this is kind of fascinating psychology-wise, because the fear of missing out is no longer about the fear of missing out on the upside. It's about the fear of missing out on the bottom, right? Oh, I'm terrified, but I don't want to miss the bottom. I got to buy. And this is partly due to the moral hazard. Okay, Brent. That we've had created over the last 15 years. What is the definition of moral hazard? Moral hazard is when you are insured against some form of catastrophe. And you can create moral hazard in a variety of different ways, but in the financial markets, it is where you are insured against losses, right? It doesn't matter what I invest in because I'm going to get bailed out. And that's what the Federal Reserve has done over the last 15 years, is create this sense of certainty of investors that, it doesn't matter what happens. If the markets decline too much, the Federal Reserve is going to step in and bail everything out. So I might as well just buy every decline because it's eventually going to go back up, because the Fed's going to ensure that it always goes back up. And that's been the case since the financial crisis. And again, there's a whole generation of investors right now that are in the markets that have never seen a bear market. They turned 18 when President Obama was elected into office. They started investing and chasing markets, a couple of years later. They've just seen basically 10, 15 years now of just, exuberant markets, right? 12% a year returns on average. That's well above the historical norms, about 50% above the historical norms, actually. So they've just seen these very vibrant markets. And again, every time there's been a consequence, whether it was the pandemic or whether it was, the Fed hiking rates, whatever it was, the Fed stepped in, somebody stepped in. We had the Silicon Valley Bank crisis that lasted 37 seconds because the Fed stepped in and bailed them out. That's what they've been trained to do. So you've got a Robinhood app, you've got a little bit of cash in the bank, you go to work trading markets. But this is quite a fascinating phenomenon that we're seeing going on right now, because again, you ask investors, you say, how do you feel about the market? Oh, I hate the market. It's terrible. It's a bear market. It's all falling apart. But what are you doing about it? Nothing. I'm buying because it's going to go back up. It's crazy. It's crazy.
Well, I think folks are just, markets, compared to where I think how markets behaved, when I was kind of first getting my start in the business back in the late 90s, you thought markets moved kind of quick then, and now I think markets move even faster. So to your point, so we have a Fed meeting this week today. It starts today, doesn't it?
Yep, we'll get their announcement tomorrow.
Yeah, so I think everybody's kind of paying attention to, well, what is the Fed going to say? Not only what do they do, but what do they say? And with that, just spark some sort of a quick, market reaction to the upside. So I think folks are they are very keen on, okay, well, if the Fed says something positive, or if the market sees it as positive, there could be a really nice reaction. So yeah, while I've been concerned about the market sell-off earlier this year, I'm not quite ready to get out. In fact, I don't want to miss the bottom. Right.
Yeah. And it is. It's quite interesting. Comment in our chat says, well, maybe it's not the same people getting surveyed. The sentiment index that I showed you is very broad, right? That's professional, retail, everybody, institutional. So that sentiment is across the board. And so, again, it's catching, a wide variety of investors that all have negative sentiment. So, yeah, maybe there's some people out there that are truly negative about the markets and are selling everything, and there absolutely are, right? I mean, that's no doubt that is occurring. But on average, you're getting this very broad negative sentiment, but we're seeing buying across the board. Every time the market declines, money flows have barely turned negative during this whole decline, and they've now turned back up. So we saw buying all the way down this decline, even though despite people were panicking over the decline itself. But again, we got to keep this in perspective, right? Too, this is a 10% decline. The maximum drawdown was like 10.1%. That's completely normal for any given year. We have 5% corrections every year. We have 10% corrections at least once every 2 years. So again, this is completely normal, right? But again, it's just when you take a look at the sentiment across the board of both professional and retail investors, institutions, etc., their sentiment is as negative. And that's the fascinating part, is it looks like we just went through a very serious bear market sentiment-wise. And that's how fast sentiment's changing now. It's like, oh my gosh, the market's down a little bit. It's terrible. It's the end of the world. And it's like, no, it's just a correction. Just keep this in, got to keep things in perspective.
Yeah, and I think that maybe it feels a little bit worse than what it really is, because, the most recent time where we had a market pull back in that 8 to 12% range was mid-July through the beginning of August last year.
Yeah, it's been a whole year.
The yen carry trade unwinding,
Yeah.
and so then you have some periods of time where markets get complacent. Investors kind of get comfortable with what's going on in the market. Then you have some things that kind of roil the markets and create some volatility here, and it's like, but you're right. It even though the market was down, about 10%, you would have thought by based how folks were reacting and just media headlines that we were going through. It was about to be the great financial crisis all over again.
Yeah. No, exactly. All right, it's interesting. Article on the website this morning talking about it. All the charts are there for you. So if you're driving to work this morning listening to the conversation, go to the website, realinvestmentadvice.com. Retail investors are bearish. That's the name of the article on the website right now. So again, all those charts, everything's there for you. All right, we'll come back. We'll talk a little bit. We've got a few questions that came in. The most pressing one, I guess, and the most interesting one is Berkshire Hathaway piling up cash. What are they expecting? Why? We'll talk about that when we come back from the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm sure when you were growing up, your parents said, don't get in a car with a stranger, especially white vans with no windows on them. Don't get into those if they're offering candy.
The Real Investment Show podcast.
And then now we've evolved to this point. It's like we can order a stranger with a car to come pick us up off of our phone. Uber just announced that they are opening up a wait list for Waymo rides in Austin. This is the driverless taxis, which is cool.
At realinvestmentadvice.com.
So now I'm not going to get into a car with a stranger. I'm just going to get into a car with no driver and watch a Roomba go around Austin trying to navigate busy streets.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I've been getting a lot of emails. I haven't really talked much about this lately, but I've been getting a lot of emails about Berkshire Hathaway and, of course, Warren Buffett. You know, and he's been piling up a lot of cash, right? Has a record level of cash on his books. And so the big question is like, oh my gosh, is he expecting another financial crash? And he's not expecting that, but he is an investor and a value investor at that. And so when there's not an opportunity in the markets to deploy capital at a fair and reasonable price, then he doesn't do it. He just holds cash. And one of his problems is now that he's so large is that he can't go buy, a really small cap company. It just doesn't move the needle, right? You got $300 billion in cash. Going to buy a $50 million company doesn't move the needle very much, right? So he's got to find large acquisitions. He's been buying Oxy, those type of companies, trying to find some opportunity to deploy cash. But the markets are rich. And so he's certainly been holding back cash. He's been trimming positions. And, recently he sold some Apple. And everybody's like, oh my gosh, Warren Buffett's selling Apple. No, he just reduced his position.
Just trimmed it.
After it's had a huge run. Not surprising, right? That's the way Warren Buffett operates. Now, is he expecting a crash? No. But is he prepared for if the markets should have a major reversal? Absolutely. He noted in his recent Berkshire kind of his annual report that markets do have events from time to time, and one of the benefits that cash has is to allow him to cut deals at very opportunistic prices during a decline. And so what he's saying is that, yeah, we're going to have a decline eventually, and it's going to cause some type of dislocation and repricing of markets that are going to create some real value-based opportunities, and he's going to be willing to step in and be that buyer of last resort, so to speak. At a time when nobody wants to buy anything, he's going to be willing to step in and go, yeah, I got $300 billion in cash, I'll buy your company. Just like he did with Goldman Sachs during the financial crisis, gave them a bunch of money at 10% preferreds, makes a killing on that stuff, still has some warrants. That's where his strong suit is. And so again, you don't read into the increase in cash as anything other than him just managing his book as a manager of a business, because again, he runs a value-based business. He's always looking for opportunities, and he's just simply saying that, markets are overvalued, and they are. There's no doubt about the fact that markets are overvalued. Does that mean they're going to crash tomorrow? No. But in the event of a return to value at some point, which will occur at some point in time, he's going to be willing to step in and buy.
Yeah, or if something that he's watching kind of goes out of favor, or maybe there's some bad earnings or what have you, it just gives him some money that he can use to nibble and get things at a better value. Maybe it's not the rock bottom price.
His nibbling's like a billion here and a billion there.
So I was going to go there. It's like, so when Warren comes to the table, they say, well, Warren, how many shares would you like? All of them. Give it all to me right now. So exactly right.
Yeah, his nibbling is very different than our nibbling.
His nibbling is a little bit different than the way I nibble, right? But it's still, but he's trying to get things at a better value. Right. It may not be the rock bottom price. And I think that's something that I see as not really a mistake, but a common theme that investors make, is they're always trying to time the absolute bottom. And you wait for that perfect time. And sometimes you don't think that perfect time comes. But if you can just get it at a better value than where it was before, that also can work. So perhaps Warren just has a little bit of money set off to the side here, so he can just nibble, buy all the shares at the right when things are at a better price.
And look, this brings up a hugely important point, because I see this a lot about Warren Buffett. They go like, Warren Buffett, he buys and holds. No, he doesn't. I mean, this just clearly proves it, right? He does have very long holding periods for stocks, absolutely. But he doesn't just buy a stock and then never sit on it, or buy a company and then just sits on it forever. Companies he owns, he holds forever, right? So if he buys a company and he's buying an operating business, he owns that forever. But on his stock portfolio side, he doesn't. And this is one of the misconstrued points about Warren Buffett that gets thrown around by a lot of the buy and hold crowd, because they're like, oh, Warren Buffett just buys and holds. No, he doesn't. And just go take a look at his 13 Fs. If you go to SimpleVisor, we have probably 50 to 60 different professional managers. Berkshire Hathaway is one of them. And you can look at the super investor portfolios and you can see what he holds. And we update the 13F filings every quarter when they come out. And you can see what he buys and sells. And, he takes profits, he adds on declines, he sells companies that aren't working. If they go out of favor, he sells them entirely. He removes entire positions from his portfolio all the time. He manages his equity portfolio just like any equity manager. He takes profits, reduces risk, rebalances, does all of that, right? So this whole idea that, I'm going to invest like Warren Buffett, I'm going to buy value stocks and hold them forever, that's fine. You can certainly invest like Warren Buffett. You can certainly buy value. That's great. But again, he may sell his position and he doesn't tell you for a quarter. And if you're not keeping up with his positions, I'm going to pick Oxy because this has been the one that everybody's talking about lately. Mm-hmm. He's been buying Oxy. And everybody's like, I'm going to buy Oxy because Warren Buffett's buying Oxy. It must be a great thing. Well, if it doesn't work out, he'll sell it. And if you're not keeping, and if all you worked off of is his headline that, he bought Oxy, so I'm going to buy Oxy and I'm going to hold it forever. If you don't keep up with his holdings, if he sells Oxy, he's not going to tell you. He's just going to publish in his 13F that he files with the SEC and say, hey, in our annual report, we sold Oxy. This is what we did. So a year later, you're down in the position 30, 40, 50%, whatever. He sold it, 8 months ago, right? So if you're going to invest like Warren Buffett, make sure you keep up with Warren Buffett. And you'll still be a quarter behind because you still won't know until after the quarter's over what he did. But at least you're better off that way. But just paying attention to where he's taking profits, where he's reducing risk, where he's adding positions, those type of things.
Yeah. Well, and in one of the earlier segments, you were talking about fund flows, right? And what I like to do too is look at where are investors buying. I like to look at this on a monthly basis, and Morningstar actually does a really nice job of summarizing as funds are coming in, where are the funds going or flowing out of. And there were a couple interesting pieces of information for the month of February.
Right.
So if
Brent,
we could,
bring this chart up?
Let's look at that second chart or second slide if we could, Brent.
No, it is interesting because fund flows tell you the whole story.
Yeah, so it's interesting. So, and this is during a period of time where markets are pulling back here a little bit, but as far as, this is in billions of dollars. So for the month of February, large blend, or the category of large blend, something that would track like a market index, a Standard & Poor's 500 index, for example.
Well, the S&P 500 index is technically large blend.
It's a blend, right? So that had an inflow of 26.7, almost $27 billion in the month of February. And then following right behind that was ultra short bond, maybe bonds in that 1 to 3 year space, and then intermediate term bonds, bonds in more intermediate maturity, somewhere in that 3 to 10 year range from a maturity standpoint. Typically, when I look at those, especially intermediate bond funds in a 401k plan, those typically have a maturity in the range of 6 to 7 years. Yep. And then interestingly, derivative income, for the third month in a row, there was derivative income was setting some record flows for new money coming into the derivative income space. And that is, investments or funds that have some sort of a call writing option to it, where, they're writing calls to generate some income. And then interestingly enough, what I found really interesting about this is so far for the year, if you look at the developed international markets and the emerging markets areas, those have had pretty strong performance for the beginning of 2025, right? So the international markets, or the EFA, the developed international markets, are up about 10% for the year. The emerging market space is up about 6%, right? So you're seeing some stronger performance there for the first time in a number of years. But what's interesting is funds were flowing out of the international markets in February. Foreign large growth had a negative 3.7 billion of out. So 3.7 billion came out, and then a global large stock blend. So global would be a combination of both U.S. and international businesses. That's why they call it a global type of asset class. Had an outflow of 2.7 billion. And I found that interesting that the international markets were having outflows in February, when I'm getting more questions these days around, hey, is it time to invest money in the international markets?
Right.
Right.
Well, again, and again, this is what typically happens, right? Is that something gets, kind of lit on fire and starts going up. So everybody's like, oh, we got to buy that because it's going up. Every year for about the past 15 years, at the beginning of every year, it's like, oh, this is the year that international and emerging markets are going to outperform, and then they fail because, again, it's about economic growth. Ultimately, it's about valuations, and again, you have to look. And one of the big misnomers right now, we were talking about people with lyabetes earlier. This is another one. International is cheap because relative to the U.S., right? Their valuations are cheaper than the U.S., but they're not cheap relative to themselves. Right, so you have to, are they of value in their own country and based on their economic growth, based on the direction they're headed, those type of things? Because where does value come from? It comes from economic activity, right? That's what generates earnings. So again, you have to look at these countries independently for where you're putting capital, and not just kind of lump sum them. I mean, they're having a great run right now, but they're extremely overbought. So I would be a profit taker in international emerging markets, and I would start buying domestic because you're going to get a reversal. Yeah. Good break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Just real quick for the break, just talk a little bit about international emerging markets. They've been on fire this year so far, been doing great. Europe, like John said, you're up about 10% in international, about 6% in EFA, emerging markets, so to speak. They've been doing great. That's been a function of the decline in the dollar. And, we talked about, it's very interesting because we were talking about, narratives and all these things that are going on. Remember a couple of years ago, this was in 2022, Mike Leibowitz and I were both writing articles about de-dollarization, the end of the dollar, how we're going to lose our reserve currency status. And we're saying that's all nonsense because you look at transactions worldwide, 70% are done in the dollar. That's not changing anytime soon. And of course, since then, the dollar's had this phenomenal rally, right? And so all those narratives went away. Now they're coming back because the dollar's declining again. Well, this is all about flows, is all it is where am I storing my reserve currency? Am I storing it in the U.S. or am I storing it in some other currency or asset somewhere else, right? And so lately, we've seen inflows coming out of the dollar, moving back overseas because the dollar's declining. Again, it's always about trade balance. It's always about currency balancing. I need to keep my currency in a relative peg to the country that I'm trading with. So if I do a lot of transmissions with the U.S., I need to keep my currency fairly close to what's going on with the U.S. dollar because that keeps my trade feasible. Again, if the dollar's too strong, it makes things too expensive for me. If it's too weak, things are cheaper for me. It's great. I was talking to some people in Canada, and they're like, "Oh yeah, I was talking to another advisory firm. It was funny because it's like, yeah, our minimum investment is $500,000, but that's $350 because we have funny money." But that's that currency imbalance, right? So of the Canadian dollar versus U.S. So here's the point about all this: is that if you take a look at the dollar, and this is a chart of the dollar versus international markets. And the dollar's been on a big decline. It is 3 standard deviations oversold right now. It is extremely oversold on multiple bases. You're going to get a rally in the dollar. When the dollar rallies, money will flow out of flow out of international markets back into U.S. because as the dollar strengthens, that's where I want my currency on an international basis. If I'm investing and the dollar's rallying, I get that currency benefit of a rallying dollar. So I move dollars into the U.S., into U.S. assets to get the benefit of the rising dollar relative to my currency. So I get kind of the double bang for my buck, rising asset prices and a rising dollar relative to my currency. I make more money. So you're going to see this transition, and this is going to come at some point. It could be next week, could be next month, but at some point the dollar is so oversold here, you're going to get a rally. And that dollar rally will suck assets out of international markets. As I was saying earlier, is that the opportunity that is building right now is to sell international, buy U.S. domestic.
And you already saw some of that with the fund flows in February, right?
Yep.
You're starting to see some of that where money's flowing out of the international markets, and the biggest inflow from into the equity space was in large cap U.S. stocks in last month.
Right.
So it'll be interesting after this month. What do they do? Does that trend really continue?
Right. Well, and again, it could portfolio managers internationally know this.
Yeah.
So and again, if they're managing a sovereign wealth fund or whatever they're doing, they know they watch that currency very closely. So if they see an opportunity, they'll start shifting money, ahead of time. Doesn't mean that markets go right up right away, but again, they're going to get ahead of that curve and buy things that are cheaper. So that's what's going on. Anyway, having said all that, one of the things that's coming up, again, we have the Fed meeting tomorrow. They also will announce tomorrow their quarterly outlook for the economy. So this is every quarter they release their quarterly updates for GDP, inflation, interest rates, Fed policy, etc. They're always wrong, right? Their forecasts are never right, but the markets will be glued to that tomorrow. So again, that's going to play into a little bit of the concern. Of course, it really won't be the announcement. They're probably not going to do anything with rates tomorrow. The big thing tomorrow, though, to watch for is what they say about QT. Quantitative tightening. This was the reduction in their balance sheet. Now, you'll remember that at the last conference, they said, we're going to pause QT until we get past this whole debt ceiling issue because we were facing this government shutdown, and they're reducing, their Fed balance sheet at a time that we're going into this whole potential boondoggle over the government shutdown and raising the debt ceiling and all these type of things, passing this continuing resolution. So they said, hey, we're going to pause that. Well, we paused it. Well, they paused it, and we passed the continuing resolution, so the government's not going to shut down. We're funded till September, so to speak. But we're going to run out of money sooner than that, but you get the point. So the interesting thing tomorrow will be as they say, okay, we're back to doing QT or not. What if they don't say anything tomorrow? What if they pause QT and now they don't say anything about it and they just stay in pause mode at this point because they've been reducing liquidity to the markets by being a kind of a quote unquote net seller of treasuries. They've been, kind of impacting interest rates to some degree by being an overall kind of they're not a buyer. They're just basically letting stuff roll off their balance sheet. As it matures, they just don't buy to replace it. So they've been impacting interest rates to a degree, keeping interest rates on the longer end of the curve, 10 years and 20 years in particular, a little bit higher than maybe they would be otherwise if they were a buyer. So it'll be interesting to see if they come back to QT tomorrow. That's going to be the one thing that everybody's kind of paying attention to.
Yeah, it's and still, with talking about interest rates, still getting a lot of questions around bonds.
Mm-hmm.
Just what are our thoughts around bonds? Do we still?
I've been loving them.
Yeah, I mean, just look at going back to that fund flows report from February. Look
Yep.
where actively managed bond funds took in like $55 billion in February. So there's a big demand for bonds out there, except the category that was in last place on inflows into the bond space, inflation-protected bonds, or TIPS, right? Which I found interesting because we get a lot of questions around TIPS.
Yep.
But that was the worst category as far as incoming fund flows in February.
Right.
But get a lot of questions
I don't
around
want
bonds.
to own TIPS if inflation's falling.
That's it.
Right.
Right.
So this is a chart that was out in Bank of America this morning. They track Treasury flows. We've had just a huge surge of money flowing into bonds
over the course, really ever since the beginning of the year.
Yeah.
So you've seen a big reversal since the end of last year where interest rates were selling up. I was like, oh my gosh, interest rates are going up. And we were saying, here on the show is like interest rates are really overbought. You're going to get a reversal. And so that's what happens. And again, this is really important to all asset classes. And again, don't get embedded into an asset class where, it's like, I'm never doing anything with it, right? Learn to take profits. Again, we were talking about earlier this morning, right? Gold's extremely overbought. Bonds are temporarily overbought. We talked about that a few weeks ago. We said, hey, bonds are very overbought here, so look for a correction in bond prices. That's what's happened. Now you're they got a little bit oversold here. They're rallying back a bit, but they're still not quite in that position for the next leg of a bullish rally. But, whether it's gold or Bitcoin, remember Bitcoin at 100,000 is like, oh, it's going to 1 million. And then now it's down at 80,000. Well, and now it's starting to trigger a buy signal. This is where you want to buy it. So the point is learn to take profits and learn to buy declines. And, that's our job as investors, is to sell high and buy low. And the problem is that we don't do that really well. We being the ubiquitous investor. We don't do that job very well. We buy high and then we hold it all the way down and then we don't buy anymore because now we're underwater and now we're hoping it'll get back to even, and so we don't buy anything. This is why we talk about here on the show is like, hey, we took profits. We sold NVIDIA back in July of last year, and then we bought it back on the decline. And just recently, we just added on this whole decline in the market of 10%. We added to NVIDIA and Arista Networks and Palantir and some of these other stocks that have gotten really beaten up, using that opportunity to add back to those positions, just rebalancing back to target, not going, not grossly expanding the position size. But when they get underweight targets, you move them back to target weights. When they get overweight targets, move it back to your target weight. So again, if you're a big gold bug, which is awesome, but gold's been doing fantastic. It's 5% of your portfolio normally. Now it's 6 or 7. Trim it back to 5. Put that money in cash. Wait for the next opportunity when gold sells off. If you just want to own it forever, hold some cash until it sells off, and then buy some more. And it's going to give you those opportunities all the time. You'll always have those opportunities to buy stuff cheap. And again, if you go back historically and look at a chart of gold prices, a good example going back to 1950. There's only been about 3 other times it's been this overbought on a monthly basis. It had 10 to 15 year periods after that where it just kind of went nowhere. So, there's good opportunities to where you can take some profits and then buy things a whole lot cheaper where you get a much better deal for your money. And that's the whole basis of investing. And that goes for every asset class, whether it's gold or silver or Bitcoin or stocks or bonds, whatever it is. Look for those really oversold opportunities to buy stuff. That's what, and again, if you want to invest like Warren Buffett, that's what he does.
Yeah, it's just making risk moves, managing risk along the way versus making huge, large, knee-jerk reactions that can be detrimental to you later down the road. It's like gardening. It's like pruning plants in your garden. Yeah. Trim them back, let them grow. Now, if there's a plant in there that's not doing well, or it's just really ugly in the garden and it's not going to go anywhere, then yank it out. But just kind of prune along the way, right?
Absolutely. And again, we have portfolios that own all these asset classes, and we manage, depending on what portfolio it is, we manage all of our portfolios exactly the same way as we were just talking about here, right? It's just a bit about having a process, and processes are important. So, all right, wraps up the show for today. Be back tomorrow with Danny Ratliff, Michael Leibowitz on Thursday to talk all about the Fed meeting tomorrow. We'll see what they say and go from there. But we'll be back tomorrow with Danny Ratliff talking about what happens in the markets today. See you then. Have a great day.